to another live stream. We've got a lot going on in the markets today. We've got the price of gold and silver both popping, both catching a pretty significant bid. And we're going to get into that absolutely, and what is driving that money into the space of the physical metals, of the safe haven assets that they are. But first of all, I want to go over something very alarming, which I came across, which to me is an indication, if there was any doubt before, that the economic impacts of this developing conflict in the Middle East will be huge, will be absolutely disproportionate in size to just about anything that we have seen so far. And the reason is, I will get right into that with this headline story. Janet Yellen sees limited economic impact from war in Israel. So, I don't know if anybody else gets chills when they see this lady tell us that everything is fine, because if anything, she's a very reliable contrarian indicator. And when Janet Yellen says, here's a quote from her: "While we are monitoring potential economic impact from the crisis in Israel, I'm not really thinking of that as a major driver of the global economic outlook." She told this to delegates of the IMF and the World Bank. It was at a meeting on Wednesday. And this one in particular, this quote: "Thus far, I don't think we've seen anything suggesting it will be very significant." Really, Janet, you don't see anything right now that would indicate that this could have significant economic impacts for all of us. I mean, this is pretty incredible. It seems to me, put a one in the chat if you see something here that could have a significant economic impact. I mean, how about the price of crude oil spiking to triple digits and much higher? How about the Strait of Hormuz getting shut down? How about Iran, that exports 2.2 million barrels of crude oil per day, having their oil infrastructure struck by the U.S. military, as was threatened on X, formerly Twitter, by U.S. Senator Lindsey Graham earlier this week? I mean, it's incredible. Yeah, silver is on a roll. Rick mentioned that. We've got the price of silver popping. Don't worry. We are going to get into that, but I just wanted to touch on that when they roll out Janet Yellen to tell you everything's okay, that's when you really need to start being concerned and looking for what the real risks here are. Now, at this IMF conference, there were some more sober assessments of the situation, some more somewhat dire prognostications, which I just want to read to you real quick, and then we'll get into what's going on in the silver market. The IMF World Bank, joined by Morocco's finance minister and central bank governor, had this to say in a proclamation: "The world has become more shock prone, with increased risk to growth, development, jobs, and living standards that widen inequalities within and across countries." And yeah, I'd say that that is a much more accurate assessment of what is going on here than Janet Yellen, who simply wants us to bury our heads in the sand and say, well, everything's fine. This is the greatest economy in the history of the world, and there are no potential financial crises on the horizon. I mean, I think it was Janet Yellen who told us back in 2019 or 2017, that there were no more economic crises on the horizon in our lifetimes. Yeah, that's exactly the kind of track record that this lady has with her forecast. Now, I'm having a little bit of issue pulling up this next headline here. Okay, so here's why we need to be paying attention. This is a report from NDTV, but it gives you an idea of how this story in the Middle East is progressing. And this is actually related to what we're seeing in the precious metals today, I believe. So the story here: "A new front in Hamas war depends on Israel's actions, says Iran." And this is Iran's foreign minister, who has now basically telling us that it's going to depend on what Israel does in Gaza that will determine whether or not we see perhaps a northern front opened by either Iran or by its proxy Hezbollah, the Hezbollah militias, which are operating in Lebanon and Syria. Now, they are much more heavily armed, much more well coordinated than Hamas as an organization. They are funded and trained by Iran. And so, right now, Israel is laying siege to Gaza, planning ostensibly a land invasion of Gaza And I don't see any sign that the pressure from the IDF and the Israelis on Gaza is going to let up anytime soon. And so this is something we really need to be watching out for, is this second front opening on this conflict. If that happens, if Hezbollah gets involved, that very well could lead to the involvement of Iran. We have the USS Gerald Ford now taking up position in the Eastern Mediterranean. We have got the USS Dwight Eisenhower, a second U.S. aircraft carrier, ready to move in should that be necessitated by the situation. But listen, folks, if this breaks out, if Hezbollah and Israel really begin going at it, and they've already been exchanging fire. There's been shelling, rocket attacks. An anti-tank missile was fired by Hezbollah militants at a Israeli position there. So, if that really turns into a second front, as the Iranian foreign minister here is threatening, this is going to be a conflict with massive economic implications. Now, let's get into what's going on in the gold and silver market. And I believe what's happening today is that as we watch this situation degenerate in the Middle East, you can see silver's up over 4%, gold up over 2% at the time I am streaming this. This is a live stream, so we're looking at this in real time. Now, it's very interesting what's going on today. You're seeing the metals coming up. Crude oil is up in a big way, also up over 4%. You've got the U.S. 10-year bond. I'm not going to pull the chart up here, but you can see it there. It's actually dropping a little bit. So we're seeing some decrease in yields on U.S. Treasuries, perhaps folks seeking out safe havens there, but they're also seeking out the safe haven of precious metals, because this is very notable. Are in the red, with the exception of the Dow there kind of eking out. See yields drop on treasuries, you tend to see investors move into more risk on assets. What's going on here? They're not moving into stocks, at least not in a very big way. Three of the major indexes in the red, but what they are moving into is precious metals. So I mentioned in a recent video that I thought that we may have seen a bottom in the price of gold and silver, barring a massive pan sell-off crisis type event. If we get a black swan, if a nuke gets popped off in Ukraine or in the Middle East or something along those lines, or if we see a massive escalation and the price of crude oil spikes up real quick, you could see a big a big sell-off among the financial sector, among paper assets, and liquidity crisis rear its head here, and just everything gets sold off. But barring that, I do believe that we may have hit a bottom in the precious metals here. Now, look, right now I'm stacking gold and silver, whether they move up, down, or sideways, because I think it's foolish to not recognize that the impact of this conflict are going to be massive. Robert Diaz says, my signal's not good. Sorry about that. If there's some kind of an issue with the live stream here, doing my best. We have kind of spotty internet in my area sometimes. Okay, right now, if you want to buy some gold and silver, here's what I think is one of the best deals out there. Over at SD Bullion, they've got these 1 ounce silver coins, $1.99 over spot. Now, are they more expensive than they were yesterday? Yeah, about 4% more expensive, as we just saw the spot price move up. But I do believe that, barring, again, a massive pan sell-off, silver and gold have probably hit their bottom. It's not financial advice, but I would still be looking to add to positions at this point. You can buy your gold and silver at sdbullion.com. They got that deal. Also, new customers can get gold or silver at spot at sdbullion.com/new. So make sure you check them out. There's a link in the descriptions right by my gold and silver. Now, I wanted to point out this story. I thought this was interesting to kind of give you an idea of where the economic impacts may fall here. Actually, before we do this, we've got 46 likes on the live stream. There's 281 of you awesome stackers out there watching. If you would, take just one moment, smash that like button, help get this information out there, because unlike the mainstream media and the powers that be, like Janet Yellen, telling you that there's not going to be any impacts from this, folks, don't worry. I'm going to tell it to you straight. And you're not going to get that in the mainstream financial media, I don't believe. So let's help get this information out there. Please do smash that like button. I really appreciate it. It helps with just everything on the channel. It's the best thing you can do to support this work if you're getting some value from this. So this is a story from Reuters from 18 hours ago. We got Israel raising $200 million in bonds, and the debt insurance costs surge. So let's break this down and talk about what this means for our economy here, and why we need to pay attention to things like this. So first of all, $200 million in bonds. how long does it take the U.S. to raise $200 million in bonds? Like, I don't know, an hour? We borrow at an astonishing rate here. So 200 millions in bonds is a drop in the bucket. But for a country like Israel, it's a much smaller nation. They don't spend like we do. So they issued these $200 million from their diaspora bond. So basically, I guess the idea of a diaspora bond is you're selling to your expatriates. And Israel makes a regular practice of this, but as a response to this conflict, they're doing some kind of emergency fundraising. And it said actually that U.S. state and local governments accounted for $150 million of the purchases. So I don't know. I guess U.S. state and local governments are borrowing money and then loaning it to Israel. I don't know. But as we're seeing this debt get taken on, one of the notable things here is that the cost to insure these bonds has moved up in a very significant way, more than 80% than the 5-year credit default swap. So, every time a loan is issued, there are these instruments which insure against that loan being defaulted on. And the cost of insuring Israel's debt against default rose 109 basis points on Wednesday. That is according to S&P Global Market Intelligence. So they're embroiled in this conflict. They're borrowing more. That is leading investors and the folks who sell these credit default swap insurance policies on this debt. The debt insurance is getting more expensive. So that means the risk of default is moving up. And this is completely normal. You would expect when a country is embroiled in a war, potentially one that is an existential threat to the existence of the nation. And I would say that it's safe to say that both for, both sides of this war, there's an existential threat going on right now. But we're specifically talking about Israel. I mean, yeah, sure, there is probably an existential threat to them. They're surrounded by unfriendly nations, and they're going to be borrowing a lot more because of war. So the cost to insure their debt moves up. Completely normal. That's what you'd expect. Well, I want to talk about this in relation to the United States, because $200 million in debt is like a drop in the bucket to us here in the U.S. This is the latest U.S. debt clock number, $33.5 trillion, folks. Yeah, that's, the real money that's getting borrowed, not these $200 million in bonds. But, the U.S. debt is rated very highly. This is an article from the House Budget Committee from August 2nd. If you recall, that was when the U.S. Debt credit rating was downgraded, only the second time in history. So Fitch Ratings, one of three private credit ratings firms, downgraded its U.S. credit rating from AAA to AA+. So basically a second-tier rating. And you can see Moody's still rates the U.S. debt at AAA, their highest rating. Fitch, it's gone to AA+, and Standard & Poor's also rates us at a second tier of AA+. And we've got 82 likes on the live stream right now, folks. 331 people watching. I know that there's 17 of you out there that could smash that like button and get us to 100 likes. Let's try and do it before the end of this live stream. I appreciate it tremendously. And, listen, if you're one of those folks who hears live streamers and YouTubers always saying, hey, smash the like button, but you never do it, I'm talking to you. Smash that like button. Help get this information out there. Okay, so the U.S. debt, you've got Israel basically getting downgraded here, and we're already over 100, so thank you all so much for that. Israel, borrowing $200 million, and we're seeing the cost to insure their debt soaring, but in the U.S., everybody thinks everything's fine. And, very interesting also, I want to kind of do a little debt detour here. We're going to, did it twice, thank you, Mark. We're going to get into how this relates. I've got some stuff I want to share with you. But first, let's just look real quick at this. This is the debt to the penny website from the U.S. Treasury. Latest number from October 11th. Now, one thing we've noticed is that following this war kicking off, we've actually seen the U.S. debt market sell-off that we were witnessing last week kind of halt. And I think that we can get a little bit of the reason why when we look at these numbers. So, as we've covered many times before, October 5th was the first time that we crossed the $33.5 trillion mark. And it was just back on September 15th that we hit 33 trillion. So that's $500 billion in 20 days that we borrowed. So it's not really surprising to me that all along the yield on the U.S. Treasuries were rising along that time. You sell a bunch of this stuff into the market, the value of the bonds goes down, and then you see the yield moving up. Because remember, the yield moves inverse to the value of the bonds. If you see rates rising on, say, the 10-year Treasury, that means the existing issues of that bond are losing value because they have a lower yield, a lower coupon. Um, Now, since that time, October 5th, according to the latest data, we've gone up only what? From 33.513 trillion to 33.537 trillion. So it's not surprising that we've seen the bond yields kind of take a breather here. Part of it is a flight to safety. Are moving into what they consider to be safe assets. Treasury yields, remember, they're AA rated, right, or AA plus. So they must be super safe. And it's only a matter of time before this debt begins to explode upward once again. Because keep in mind, the president just asked for $100 billion aid package for Ukraine. He's promising more aid to Israel. Certainly, if a second front opens in the north with Hezbollah or even Iranian involvement, we're going to be dumping a lot of munitions over there, and we're going to be to right now. But the one thing that is guaranteed is that we are going to be sending a lot of borrowed money into these conflicts. And so one thing I think is going to happen is when, the other shoe drops in terms of the massive amount of borrowing which is about to take place for this conflict, we're going to see the yield spiking back up again. Because remember, yields move up when the bonds go down in value. When the Treasury is borrowing a ton of money and selling a ton of bonds onto the market, it drives the value of the bonds down. Supply and demand. It's like anything else. Bond markets are a little weird to think about, but once you see what's going on here, you can see that we are likely to be headed back to much higher yields. And that's going to be a huge problem, of course. But I want to talk more about the credit ratings for the U.S. government debt because, there's a couple ways you can think about this. You might think of the U.S. debt as being AAA, really no matter what, right? Because we can always print the money. So we're good for it in that sense. The Federal Reserve can always come in and monetize any amount of debt, drive yields down if that's necessary. It's probably where we're headed one way or the other. But on the other hand, there's no way that the current level of debt can be repaid in anything other than devalued currency. So in that way, it's almost like a junk status, right? I don't really see much in between in terms of ways to look at this. But I want to look at this article from Wikipedia, which is worth checking out and reading in depth. But the title of the article is Credit Rating Agencies and the Subprime Crisis. So I want to go back and hop in our time machine here back to 2007, 2008, and read you a little bit about this and kind of think about the U.S. debt rating in terms of this story, in light of this story. So, credit rating agencies, firms which rates debt and debt instruments and securities according to the debtor's ability to pay lenders back, played a significant role at various stages in the American subprime mortgage crisis of 2007 and 2008 that led to the Great Recession of 2008-2009. The new complex securities of structured finance subprime mortgage could not have been sold without ratings by the big three ratings agencies. Talked about them just a moment ago. Moody's Investors Pension Fund were restricted in their bylaws to hold only the safe securities, i.e., securities rating agencies designated AAA. Remember, that's the rating that currently is being assigned to U.S. debt, at least rating agencies. Pools of hundreds of billions of dollars of the AAA securities were done to junk status by 2010. The downs and losses came to over $500 billion. So thinking about that, I have more folks in the live stream saying bad connection today. Maybe. I don't know. I'm not watching the live stream, so you tell me bad connection today. I'm sorry about that. I will try to fix that by the next one. It is a problem with live streams, but the thing about the live streams versus the pre-recording videos is with things changing as rapidly as they are, if I make a video and then edit it and release it, it's probably going to contain dated information by the time it goes out. So I'm sorry about the connection problem. Figure out what's going on with that. But I want to think about today's AAA ratings of the U.S. national debt compared to those ratings of those, subprime loans back in 2000 and 2008, because what we're headed towards, maybe the Fed is jamming me. A few people in the chat saying that maybe this info, it's good when the powers that be are jamming me right now. It's probably just my poor internet connection, honestly, which is kind of intermittent. So sorry about that. But Think about what we are headed towards here in terms of an economic crisis. When in 2007, 2008, it was a real estate crisis and mortgages, $3 trillion worth of debt, and you saw what that led to. Well, now it's $35 trillion of US debt. What we're headed towards is a sovereign debt crisis and a currency crisis. And the consequences will be so much bigger than what we faced in 2008 that, I mean, really, it just boggles the mind. And ultimately, this debt is going to continue to get piled on. Now, the ratings agencies, they can't rate the U.S. national debt at what its actual creditworthiness is because they'll, be penalized somehow by the lawmakers. That's just how it works. So I see people dropping off the live stream here too. I'm assuming it's got to be connection issue. Again, sorry about that. Apologize. But yeah, we're headed towards a massive crisis here. This national debt should not be AAA rated, and the war is only going to accelerate the pace at which we arrive at that. And that's why the price of gold and silver are catching a bid today, because investors are coming to the realization that we're headed towards, something very major here. And I think it's interesting that at the same time, you see stocks dropping, you see the major market indexes dropping, and you also see the yield on the 10-year treasury dropping. You're seeing gold and silver pick up. So yeah, SD Bullion just announced that silver is up $1 today. Yeah, it's only going to go higher from here, I think, unless we get a major pan sell-off event, in which case, very likely, we could see the paper price at least drop. Although I'm more and more convinced that if we do see a major pan sell-off event, that even if we see the paper price for silver dropping, if folks are liquidating their futures contracts and their ETFs, that the price of physical may just detach completely from the paper markets, and we could see the premiums on physical metal soar as the paper spot price drops. So that's all I've got for you today, folks. The impacts of this war are going to be very significant, despite what Janet Yellen tells you, and we need to get prepared. And don't forget, today is the day of jihad called for by the leader of Hamas. So, keep your head on a swivel, stay safe, get prepared, and don't put it off until tomorrow, because tomorrow could be too late, and the economic impact here is going to be huge. Stay safe and happy stacking, everybody. Smart Silver Stacker, out.